Welcome to the Stock Market Palantir. Today we are going to talk about Rich Tech Robotics Inc., or RR. This is a really fascinating microcap growth equity because it displays a classic market dichotomy. You have this visible, highly compelling operational success running headfirst into a severely distressed capital structure.
Indeed. And I think the fundamental disagreement surrounding RR is whether it's high volatility and, all this dramatic recent price action. Is it primarily driven by the tangible operational milestones, the robots we can see, the high-profile partnerships? Or is it really driven by the underlying structural necessity of continuous equity dilution, which is required just to maintain basic solvency?
Right. And my position is that the market movement, especially the sharp upward spikes and the sustained interest we're seeing, is a direct reaction to that technological validation and the visible operational achievements. I mean, the market sees the successful product deployment and views it as validating the long-term thesis, and it's choosing to look past the immediate financial hurdles. I believe the operational roadmap is what's driving price discovery here.
And I'm going to maintain the opposing view. The price action, in my assessment, is fundamentally dictated by the company's severe and, frankly, accelerating cash burn. And because of that, its dependency on these sophisticated liquidity harvesting financing mechanisms. Until this reliance ends, the stock price remains a function of supply management by institutional players, not organic operational demand.
I see why you emphasize the financial mechanics, but let me offer a perspective rooted in, market psychology and narrative strength. The retail market, which drives so much of the volatility here, is reacting rationally to tangible proof of life. Their flagship products, the service robots, Adam and Dex, are inherently consumer-facing. I mean, just consider the impact of the partnership with the Vegas Golden Knights, where Adam is visibly pouring drinks at an NHL game. This visibility is incredibly compelling, and it allows the stock price to, partially decouple from the immediate negative financial statements. Investors are buying the future, not the present balance sheet.
That's a compelling argument regarding visibility, I'll give you that. But visibility in this context serves a very specific financial purpose. It generates the necessary excitement to enable the sale of stock. The financial statements expose the true priorities. Let's look at the company's most recent 10Q filing ending June 30th, 2025. What we see is revenue contraction. Specifically, revenue hitting only $1.18 million, which is an 18% decline year over year. Now, for any growth stage robotics company reliant on scaling, an 18% contraction is not a hurdle, it's a sign of profound operational failure. The pilot programs just aren't converting into fleet-wide contracts. Furthermore, the net loss over the previous 9 months tripled, reaching $13.34 million. This cash burn is structural distress. The critical evidence supporting my structural thesis is the dramatic change in the additional paid-in capital. We call this APIC. APIC is the value of shares sold above their par value. Over those 9 months, APIC surged from $49.7 million to $126.1 million. That difference confirms over $75 million was raised almost exclusively through equity sales. So compare that $75 million cash injection to the less than $4 million in total revenue they generated. The operational failure necessitates dilution, which confirms that the primary product being monetized is the stock itself, not its robots.
Okay, that ratio, 75 million raised versus 4 million in revenue, is certainly staggering, and I do concede the financial filings reflect acute capital requirements. However, I frame the purpose of that capital differently. In a sector like high-growth robotics, which is incredibly capital-intensive, massive investment is required upfront for R&D, for manufacturing scale-up, and for strategic partnerships. So when capital is raised for these purposes, it hits a peak. And while revenue is lagging, the other key operational validation you ignored is the integration of NVIDIA's Jetson Thor platform. This links RR directly to the highly potent NVIDIA trade, providing a powerful catalyst that retail investors are eager to participate in. This future focus, tied to high-value partnerships, justifies the speculative capital allocation. They're betting that the eventual robotics as a service, or RaaS model, will deliver sustainable recurring revenue streams.
I'm sorry, but I just don't buy the upfront investment justification when we see an 18% revenue contraction. If R&D was translating into successful product placement, we would see revenue growth, not decay. The RAS model is the promise, sure, but the reality is that operational performance is declining. And this fundamental disconnect, where marketing visibility is high but operational revenue is low, is precisely what creates the need for extreme equity financing. No matter how compelling the narrative or how strong the NVIDIA association, without revenue growth, the company must continue to print shares, actively destroying shareholder value just to fund operations. The core issue remains: operational failure forces financial desperation.
But if the company is in financial desperation, why does the stock constantly display such massive volume spikes and become the subject of such intense focus? The market isn't just discarding it. Retail conviction, with sentiments like robots are back at 370, shows genuine underlying demand for the asset. If this were a truly worthless venture, institutions would simply let the stock bleed out. The fact that sophisticated arbitrage exists, involving these complicated financing mechanisms and massive off-exchange shorting, suggests to me that there is a genuine, valuable asset underneath that requires active price capping and suppression efforts.
Well, that takes us directly into the mechanics of institutional supply absorption, or what I call liquidity harvesting, which is fundamentally driving the volatility. And I have to challenge the prevailing retail thesis that this volatility is due to some organic short squeeze fueled by Reddit. What we are really seeing is institutional distribution disguised as market movement. The data confirms that off-exchange short volume routinely exceeds 30 or 40% of daily volume. We cited the 40.21% short ratio on November 25, 2025. This suggests that institutional players are using dark pools to distribute newly created or acquired shares. They short the stock as market makers to neutralize the retail buying pressure generated by positive PR, maintaining a price ceiling. Then, they fulfill those short obligations by converting notes or warrants acquired at deep, toxic discounts, often through a standby equity purchase agreement, or a SEPA. A SEPA allows the institutional investor to buy shares at a fraction of the market price, sometimes quoted at 96% of the volume-weighted average price, or VWAP. This discount ensures immediate profit upon conversion and immediate distribution. It creates a cycle where every retail purchase based on good news is met immediately with cheap, freshly issued shares, preventing any sustained upward movement.
That is an interesting breakdown of the financial engineering involved. And I agree that the existence of separays and these extreme discounts, like 96% of VWAP, introduces highly toxic dynamics into the capital structure. However, I would frame the result differently. This aggressive shorting and distribution confirms a structural scarcity of shares needed to satisfy institutional demand. We see evidence of this scarcity in the fail to deliver the FTD spikes. These FTDs, which hit over 1 million shares in October 2025, represent transactions where the settler failed to deliver the physical shares on settlement day. This failure suggests genuine difficulty in locating shares to borrow or sell short. These massive FTD spikes signal the potential for mandatory buying in, often referred to as reg show closeouts. If institutions didn't believe the underlying asset had future value, they wouldn't risk those closeouts. They would simply wait for the market to discard the stock. Instead, they are actively manipulating the float to suppress a move that inherently wants to go higher based on the technological progress.
That is a clever way to interpret the FTD data, suggesting it represents scarcity, but it ignores the elephant in the room, the definitive signal of an impending supply shock, which makes those FTD spikes temporary noise against a permanent distribution trend. I'm talking about the massive share authorization approved on November 14, 2025. That approval increased the authorized Class B shares from 200 million to an astronomical 1 billion. 1 billion. When you compare that reserve of over 800 million new shares to the current outstanding float of roughly 158 million, you realize this is a nearly 500% increase in potential future supply. This action creates an immediate, massive, and permanent supply overhang. Companies do not incur the regulatory cost of increasing authorization by fourfold unless they intend to utilize that equity rapidly to fund operations and satisfy note conversions. The market correctly discounts the stock today in anticipation of this future dilution, which acts as a structural ceiling, that no amount of NVIDIA partnership news can break.
I'm not convinced that the authorization signals impending disaster, but rather necessary flexibility. I mean, increasing authorized shares is a proactive step for any company funding multi-year growth plans in a capital-intensive sector. They need the ability to raise capital quickly when market conditions are favorable, especially given the historical volatility and the difficulty microcaps face in securing traditional debt financing. Furthermore, we have to acknowledge that management is attempting to stabilize the company. The stock is currently trading safely above the $1 NASDAQ compliance minimum, maintaining a price between $3 and $3.60 recently. While you correctly point out the historical low of about 60 cents, the immediate risk of delisting is mitigated. And regarding future dilution, if it does push the price below $1, a reverse split, which is often viewed negatively, can be a strategic move. It cleans up the capital structure, reducing the authorized share count and increasing the per-share price. That makes the stock more appealing and accessible to institutional funds and broader mutual funds that have minimum price requirements. It's a management technique for float control, not just a signal of failure.
To call a 500% share authorization for future dilution necessary flexibility overlooks the simultaneous approval of the Evergreen Stock Option Plan. This plan automatically reserves 18% of outstanding shares annually for management compensation. This is a critical detail. It permanently aligns management's incentive structure with issuance and maximizing the amount of capital raised rather than maximizing price appreciation for long-term shareholders. This guarantees annual dilution solely for internal compensation, which just compounds the pressure of the 1 billion share overhang. The combination of the SEPA-driven liquidity harvesting, the massive supply shock potential, and management compensation tied to issuance, it all confirms that the company's success, at least in the short term, is predicated on the continuous destruction of existing shareholder value. The price action is defined by distribution, not accumulation.
Ultimately, the tug-of-war between the technological promise and the financial reality is the defining characteristic of rich tech robotics. The genuine operational milestones, the visibility of Atom, the strategic NHL partnerships, and the association with NVIDIA will continue to attract speculative capital, eager to capture the next successful robotics pivot. The long-term value, if it's realized, lies in the company's technological progress and its ability to finally transition from pilot programs to scalable RaaS contracts.
I concur that the company sits precisely at the junction of two divergent realities. However, until rich tech robotics achieves positive cash flow and decisively ends its dependency on these highly toxic financing mechanisms, the SEPAs, and the massive 1 billion share supply overhang, it remains fundamentally a highly speculative trading vehicle. The price action will continue to be characterized by extreme volatility with a structural ceiling, as every piece of positive news catalyzes retail buying that is immediately and systematically absorbed by institutional distribution.
Understanding RR requires the serious investor to analyze the situation through both timelines, the exciting, future-focused operational reality and the current, brutal financial reality.
And recognizing which timeline dictates the daily trading pattern is absolutely essential for navigating this volatile stock.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.